Welcome to Intuit's Bookkeeping Certification Program. This program is made up of 4 courses: Bookkeeping Basics, Accounting for Assets, Liabilities and Equity in Accounting, and Financial Statement Analysis. Each course has similar activity types. These include videos, discussion prompts, and practice. In the videos, you'll meet your bookkeeping coach, Bianca. Bianca and her Bookkeeping Rescue show will make an appearance throughout each course. You'll go through bookkeeping topics and situations with Bianca as a guide. The discussion prompts are your opportunity to think about what you've learned and consider what it means for you. Lastly, practice will consist of quizzes and interactive activities where you can self-check what you've learned. Now that you know what's waiting, you're ready to start. Welcome back to Intuit's Bookkeeping Certification Program. If you followed the courses as planned, you've already practiced foundational concepts essential to becoming a solid bookkeeper. You've learned about the accounting cycle, basic financial statements, and you've just finished learning about the left side of the balance sheet: assets. As you know by now, accounting is all about balance, so we can't just cover the asset side of the balance sheet. In this third course, it's time to take a journey to the right side of the balance sheet and explore liabilities and equity in accounting. Throughout this course, you'll explore the following: current and long-term liabilities, notes payable, sales tax liabilities, payroll for employees, non-employees, payroll taxes, and shareholder equity. As with the previous lessons, this course also contains advice from experts, demonstrations, practice activities, readings, knowledge checks, graded quizzes, and peer discussions. The practice you do throughout the course will prepare you to complete another case study by building on the knowledge you have learned. Bookkeeping is not for the faint of heart, and we recognize and fully support your courage and tenacity for success. When all components of this course are completed, you'll add the following skills to your abilities. Describe the 3 main characteristics of liabilities. Demonstrate an understanding of the basic payroll accounting functions and tasks. Identify the key components of stockholders' equity. Use the accounting equation to describe the financial position of an organization. To power success, it's recommended you fully complete courses 1 and 2 before beginning course 3. And, as a quick reminder, the intention of this course is to fit into your life. You don't have to complete everything in one sitting. We recommend allowing yourself 4 to 6 hours per week to review and complete the course material. As always, have fun and keep practicing. These accounting principles and terms are almost like learning a new language. It takes practice and time to become fluent. Good luck and happy bookkeeping.
Hey, you're back. I thought for sure you'd take some time off after that eternal summer case. But clearly, you've got the bookkeeping bug. Now you can't stay away, am I right? Anyway, I really appreciate all your help on that last case. Between the dynamic of those 2 sisters and all of that inventory and assets, I know those books weren't easy. But we got them on the right track, which is what Bookkeeping Rescue is really all about. Well, that and maybe a friends and family discount on my next massage. You know, you've impressed me. You're really crushing this bookkeeping thing. But hey, they say a student is only as good as their teacher. Are you ready? I've got another case that I could use your help with. I'm warning you, though, this one is not all incense and cucumber water. You might get a few grease stains. Let's get going. We've got work to do. Okay, our next rescue is a business called Crankshaft Customs, a custom car and body shop. Hey, look, there's a Crankshaft Customs commercial video file. Let's check it out.
Hey there, Xavier here from Crankshaft Customs. Think about this scenario for a minute. Let's say a family member wasn't feeling well and needed some medical advice. Who would you go see? A doctor or the guy who read about the symptoms online? Pretty easy, right? Here at Crankshaft Customs, we know that your vehicle is part of your family. So whether it's custom work or general maintenance, when you need automotive advice, make the right choice. Bring it to Crankshaft Customs. After all, they don't call me the engine block doc for nothing.
The engine block, Doc? Nice. All right, let's see what we're working with here. So this guy Xavier called me because he's looking for some help. I guess foot traffic has been pretty slow and he's having some cash flow problems. That's never a good starting point for us. On the phone, he said he had some thoughts on other ways to generate revenue, but wasn't really sure what that would mean for his bookkeeping. Well, it should be interesting at the very least. What do you say? Are you ready to go meet the guy? Wow, Xavier, this is quite an operation that you have going on here. OMG, is that a cherry red 1963 Corvette Stingray? What I wouldn't give for a car like that.
Yep, just came in today. It's a beauty, isn't it?
I'll say. So tell me a little bit about yourself, Xavier. How'd you get into this line of business?
Well, to be honest, me and my sister really grew up with nothing. Our dad worked a couple of jobs to make ends meet and make sure that we had a roof over our heads. But despite all of that, every weekend the three of us would work on his old '73 Chevy Nova. I think that's really where I got my love of old cars and why my sister and I started this shop. It was because of him.
That's just beautiful, Xavier. Truly. Oh, get it together, Bianca. Okay, Xavier, so tell me what's going on with your business. You obviously didn't call me here to look at cars and reminisce.
Yeah, well, when we first started this business, things were great. We even had a waiting list going. I couldn't keep up. But ever since people started working from home more, they aren't using their cars as much and foot traffic has slowed down. Now we're having cash flow problems. I'm having trouble paying for parts that I need, but I can't make sales without those parts. It's a vicious cycle, you know?
Yeah, I totally get that. Well, I'm sure once we take a look at your books, we can get things moving again. Have you thought about how you might drum up some more business?
Oh yeah, my sister and I came up with this idea. Check it out, a subscription-based car detailing service. People pay a monthly fee and can bring their car in to get cleaned.
That's pretty brilliant, actually. So what's the problem?
Well, I'm not actually sure how to deal with this from a bookkeeping standpoint.
Ah, well, in that case, you've called the right person. I really like this Xavier guy. Not only does he have great taste in cars, but he's got great taste in bookkeepers, too. Let's take a look at what we will be doing this time. I know there are some new concepts here, but don't worry. Just like before, I'm along for the ride. See what I did there? Car joke. Now, I haven't really dug into Xavier's books yet to get a sense of how big of a hole we're going to have to dig out of, but I think it's a safe bet that I'll need your help about 4 to 6 hours per week. Like last time, I'll be here to help you with some of the newer concepts, but that doesn't mean I'm going to do all the work for you. That's what you're getting paid for. Wait, am I paying you? Anyway, you clearly know what you're doing. I have the utmost faith in you. Okay, time to pay the bills. Here's a quick word from our sponsors.
Hey, you. Yeah, you. Are you thinking about switching careers? How's that resume looking? Nice. So, how's the job search going? That good, huh? Sounds like you need a roadmap for your job search. Well, lucky for you, we here at Jobs and Stuff have got you covered. We have compiled our industry-leading knowledge and job search know-how into an easily digestible 4-step plan that will not only give you a direction for searching for new jobs, but will also give you tips for optimizing your time spent looking. And don't worry about your dog eating your homework. This job resource is digitally bound and made to last. So don't wait. Get your copy of our How to Plan Your Job Search resource before it's too late.
All right, time to put the rubber to the road. Are you ready? Well, buckle up. It's time for another bookkeeping rescue. So detailing, huh? What gave you that idea?
Well, I already got clients that have been asking me if we offer it. We do a very basic one for our customers who bring their cars to us. You've already noticed the kind of cars we service here. I can't give a customer back a scuffed-up 68 Chevelle. Our clients notice that stuff.
Fair enough. Well, I think it's a great idea. Seems like you've put some thought into this.
I started out doing detail work myself. It's what put me through mechanic school. First shop I worked at was for a guy named Winston who was willing to put me to work. If this thing takes off, maybe I could do the same. I got some cousins who are interested. Not too many summer jobs out there right now, like when I was coming up. A subscription-based service might even help us take it mobile.
You're a good guy, Xavier. I'm going to do what I can to help you get this off the ground. What do you think you'll need to get started?
Could use a new pressure washer. The wet-dry vac is on its last leg, and if we can raise enough money, maybe even a steam cleaner, we'll also need a lot more microfiber towels, wax, and all that.
I see. You're thinking of a bank loan then. You'll need to show them your financial statement. If you've got a balance sheet handy, I could take a look.
Yeah, that'd be awesome.
I don't know about you, but I am very motivated to help Xavier get this detailing thing going. If he decides to go for a bank loan, though, he'll definitely need to get his books in order. You can't hand a bank a scuffed-up financial statement and hope they throw money at you. We need to take stock of where the business is, and the balance sheet is a good place to start. Which means we'll need to go over his assets, liabilities, the whole shebang. And just like we did for assets, we'll need to give you a deeper peek at liabilities. If Xavier's newest venture pans out like we hope it will, then that will affect what liabilities he'll have on his balance sheet in a big way. Xavier will need to share a balance sheet with the bank. Remember, a balance sheet is a snapshot of the financial health of the business at a given time. You remember this, don't you? Yep, that's right. It's the accounting equation. The balance sheet is essentially a reflection of the accounting equation, showing what a company owns versus what it owes. As you can see, liabilities are a large part of that equation. Liabilities outline what the company owes and represent the obligations that the company has to its vendors, suppliers, and lenders. Put another way, liabilities represent the claims against a company's assets. Do you remember what two major categories of assets a balance sheet shows? If you guess current and non-current assets, then you, my friend, are exactly correct. Well, guess what? I'm going to make your day a little bit easier by telling you that the balance sheet shows two major categories of liabilities as well. You won't be surprised to hear that they are also referred to as current and non-current liabilities. A company's current liabilities are those obligations that will come due within 1 year. They're also known as short-term liabilities and include things like accounts payable. Let's hear from an expert as they explain more about current liabilities.
Well, current liability is borrowing money that you intend to pay back pretty quickly. So in the scenario, we need a pressure washer and don't quite have enough cash in the bank to make that happen. So what do? You go to a bank, or maybe you got a friend, I don't know, but you go to a bank and get a loan. And it's usually a current liability is something that's going to be paid off within a year. So a pressure washer wouldn't be too expensive, probably something you can make payments on that short-term loan pretty quick and maybe get it paid off within the year. But that is usually what a current liability is used for. We don't want to hang on and have a long mortgage. This is just something we're just going to, didn't have quite enough cash for, and we're just going to pay it off as fast as possible. So some current liabilities could be in different forms. Some banks offer lines of credit, which is basically say they were approved for a $10,000 line of credit. When they want to buy the pressure washer for $8,000, they can pull from that line of credit and buy the pressure washer. Obviously, they have to pay that credit line down and hopefully off pretty quick. Might have a higher interest rate because it is a short-term liability. So you want to get it paid off pretty quick. Other short-term liabilities or current liabilities, that's two ways of saying it, is a credit card. Think of it, I have a credit card that has a $10,000 credit limit. Well, maybe I could put the pressure washer on that and pay it off as fast as possible because, as we all know, credit card interest can get a little pricey. So that would be another form. Sometimes even owners of companies or people who are principals in the company might loan the company money temporarily during a cash shortage. That could be another version of a short-term or current liability.
Non-current liabilities are a company's obligations that will not come due within 1 year. For that reason, they're also called long-term liabilities and include things like notes payable. Let's hear from an expert as they explain more about non-current liabilities.
There's current liabilities and then there's non-current liabilities. Some people also call them long-term liabilities. What's the difference? In general, a current liability is probably something the company wants to pay back within a year or so. Long-term would be something that's going to be maybe amortized out over years and years and years. So let's give some examples. How about if they get that pressure washer, but they don't have a truck to drive it around in? So we need a new truck. Well, a truck usually you don't pay off within a year. That would be a long-term liability or something, a non-current liability. Two ways of saying the same thing. So you get the truck, you're going to make a monthly payment on that. It's probably going to last 5 to 6, sometimes 7 years, and you're going to pay that off slowly. So that would be one example of non-current. Some companies buy equipment, they buy land, furniture. I mean, there could be all kinds of things that might extend to a long-term or a non-current liability. Basically, it's going to take a few years to pay off, maybe even up to 30 or 40 years, depending on what it is.
Between assets and liabilities, you've been exposed to a wide variety of account types, and we haven't even gotten around to equity yet. Just as assets have a normal balance, so do liabilities. You know that each account has a debit side and a credit side. Well, the normal balance is the side where we normally expect to find the balance of the account. This is also referred to as the natural account balance. Assets have a normal debit balance, meaning we expect to find the balance of that account on the debit side. To increase an asset, we would debit it, and to decrease that asset, we would credit it. On the other hand, liabilities have a normal credit balance, meaning that we expect to find the balance of that account on the credit side. To increase a liability, we would credit it, and to decrease that account, we would debit it. Having said that, there are liability accounts where the normal balance is expected to be a debit balance instead. The expected balance runs contrary to what would normally be expected, so we refer to those as contra-liability accounts. So what, right? Who cares? All accounts have a normal balance, big whoop. Accounts can still have either a debit or credit balance depending on the transaction being recorded. The real benefit of knowing the normal or natural balance of a particular account is that seeing accounts with a balance other than its normal balance is a good indication that an error has been made. At the end of the day, the real point of all this is that we're trying to help Xavier get his books in order so that he can get that loan, so that he can prosper even further with his business. There he is. Been looking for you, sir. I've got some great news for you.
Could use some good news. Hit me.
Went through your balance sheet and things look pretty good. We'll have to go through your books, though, to make sure.
That's a relief. I'll keep looking into the equipment and supplies we're going to need. Hopefully we can get a bank loan or something.
We'll do what we can to make sure everything is in order.
Appreciate it. We're gonna need it. Things are a little tight right now.
What's all this, Doc?
Well, hey there. I'm doing research for the detailing business. I found an awesome supplier. A loan would cover the pressure washer and a new wet dry vac, but then I'll need to buy supplies pretty regularly. I'll need to have the basic supplies on an ongoing basis, and don't know how to spread out a loan to manage that. I'm not sure how to manage what I'll need to cover every month.
Hold up. You know you don't have to pay cash up front for everything in your business, right? If you're having cash problems, you can set up a line of credit with your vendor. We could do that with this magic supplier you found.
I think my credit cards are close to maxed out, if that's what you mean.
I see I have some explaining to do. Let's get to it. Xavier doesn't have the cash to pay for everything he needs up front, but he doesn't necessarily need it. A line of credit with his supplier would give him some leeway to pay for everything he needs each month. We looked at his assets and liabilities, and his current liabilities at the moment are not more than the amount of his current assets, so he shouldn't have problems paying creditors regularly. I think this could be a good option for him. Let's walk him through how to apply first. Come on, I know you are excited as I am to get cracking at this. Every business, especially small and medium-sized ones, needs to keep an eye on cash flow. You know how it goes. You have to pay vendors when you receive their goods or services, but your customers typically pay 30 days later, if you're lucky. This can strain your cash flow, like it's straining Xavier's. Opening a business line of credit with your vendors allows you to buy goods or services on an account and pay for them on a monthly basis called a term, rather than immediately. Why is that a good idea? Flexibility to manage your cash flow. And a supplier who gives credit is effectively financing a business for free. This makes it less expensive than other alternatives. Sounds pretty great, right? Let's go over what Xavier needs to obtain a line of credit for his business. Let's have a listen to my colleague who can tell us more about setting up a line of credit and what's important for bookkeepers to know.
If a client does get a line of credit for their business, we need to set that up on the books. So basically, a line of credit would be a current liability. So you could set that up in the current liabilities area as a line of credit. So basically, the way the line of credit works is it has a zero balance until something is actually drafted from it. So let's say we are going to buy that pressure washer or whatever it is, a piece of equipment for the company. When it's time and they need the cash to go to Home Depot or somewhere else to buy whatever this is, they can transfer money from the line of credit to the bank account. And basically what that's going to do is credit the line of credit for that value and debit the bank account. That'll put money in the bank so you can write that check or whatever it is to go purchase that piece of equipment. And that credit side of the transaction is going to actually show the balance due to the bank. So that's basically how a line of credit works. When they start making payments, it'll be the opposite. You're going to credit the bank and then debit the line of credit until that line of credit is paid off.
Well, that was easy. Acme Supplies was happy to start a line of credit for Xavier. I mean, his bookkeeping needs some help, but he is a likable guy, and that is priceless. Much like moi.
Sometimes our clients will go out there and go get a line of credit and not let the bookkeeper know. So sometimes we end up finding things out after the fact, and usually a transaction or something like a transfer will make us aware of that there's something going on here. So in general, hopefully your client is upfront with you and says, hey, I just took out a $20,000 line of credit. Here is the document. And usually the bank will draft a document that they signed, agreeing to that line of credit. That would be great if they had that they could provide to you or, document share with you. But if not, it's usually the banking activity that will trigger your knowledge of such a thing. For instance, if you do have access to your client's bank website, which a lot of clients do give read-only access to their bookkeeper, you would probably notice that they have a business checking and a business savings, and then you might even notice a business line of credit. So basically another account will show up on their bank website. That might be one clue that they pulled a line of credit. Another way to know is when they start drawing on the line of credit. So when the line of credit is first taken out, there's no real money exchange. It's just an I agree to pay you back if I borrow on it. So basically, when a line of credit is used, it's usually done with a transfer from the line of credit to the bank account. So you might end up seeing a deposit, just miraculously showing up in the bank account that might say line of credit or something in the memo. At that point, I would definitely have a conversation with my client if I had not heard of it yet. Did you pull a line of credit? Who's the bank? What's the credit limit, et cetera, et cetera. So usually the draft on the line of credit that deposits to the bank account will make you aware of that. And then you'll know to set up that current liability account and then do the transfer from the line of credit to the bank, funding the money like a deposit to the bank account. And then whatever they borrow is what gets deposited to the bank. Again, as they start paying it off, it'll probably be a transfer going right back to the line of credit. So hopefully the bank is giving enough information on the bank statements to kind of make this clear, but always ask your client for more information if you see a LOC or some sort of note message like that on the bank's statement or on their website or something like that. It's just a clue that they might have pulled a line of credit.
A vendor line of credit is a current liability. It falls under accounts payable because it is money the company owes at a later date. Remember that Acme Supplies asked for a 30-day term? That's typical for a line of credit, so no surprises there. Xavier will receive an invoice from the supplier, and he'll have 30 days upon receiving it to pay it. Purchases made on vendor lines of credit are recorded as soon as the bill arrives, even though the payments have not yet been made to the supplier. This is how the transaction of buying $1,000 of cleaning supplies is recorded in the journal. Now, let's look at making payments for credit. By the way, if you ever need to get someone's attention, try missing a couple of payments and see how popular you suddenly get. When Xavier later pays the bill for the $1,000, he debits accounts payable for $1,000 and credits cash for $1,000. The net effect on accounts payable combining both the purchase and the payment is zero. That makes sense, right? What we did in the previous entry and this one counts the amount that Xavier owes his supplier as a liability, accounts payable, only while he owes the money. We have been talking about lines of credit and Xavier's purchase of supplies for his new detailing business. But there's another liability we should consider with this new part of his business. Xavier is going to be collecting subscription payments for his detailing work. This means he will have some deferred revenue. Based on Xavier's terms, the services will be used within 1 year, making it a current liability. It's a liability because there's always a possibility that the buyer might cancel the order or the work might not otherwise get carried out. Look, just because that money is in your bank account doesn't mean your client won't ask you for a refund in the future. People are unpredictable. Since deferred revenues are not considered revenue until they are earned, they are not reported on the income statement. Instead, they are reported on the balance statement as a liability. As the income is earned, the liability is decreased and recognized as income. Look at this example of when Xavier collects a $1,000 payment for detailing services over the year that have not yet been performed. Remember the normal credit balance that current liabilities have? When Xavier receives the money, he debits it to the cash account because the amount of cash his business has increased. And he credits his deferred revenue account because the amount of deferred revenue is increasing. As he performs his services, parts of the deferred revenue become earned revenue. So, if he details for a client once per month, The amount of money equal to the monthly service becomes earned revenue after he performs the service each month. Phew, do you think you have all that? Let's take it one step further. You know, I like to push you a bit. Sometimes you have to push yourself a little. You are capable of more than you know. Usually. Mostly. The other day, I did a cartwheel thinking it was like riding a bike. It's not. Let's say Xavier sells a detailing package at the beginning of the quarter to Amanda for $300. Because he hasn't earned any of that revenue yet, he records Amanda's $300 payment as deferred revenue using the following journal entry. Because the subscription entitles Amanda to 3 months of detailing, he decides to recognize $100 of the deferred revenue every month. 300 divided by 3. Let's say he sold Amanda the pack on January 1st. That means he would make the following journal entry on January 31st to decrease the deferred revenue liability by $100 and increase membership revenue by $100. He would continue to recognize $100 of the revenue at the end of every month until the deferred revenue account reaches zero, at which point the full $300 would be recorded as earned revenue on his income statement. Doc, how you feeling about this line of credit?
Yeah, B. I'm feeling good about it so far. I'm really ready to move forward with setting up this part of the biz.
You need something to get people to sign up for these prepaid subscriptions, some kind of enticing or snappy slogan.
How about car detailing? Because you're too lazy.
We may need to work on that a little. Fuzzy dies. That brings back memories. I had a pair just like that in my first car. They were purple and white to match my favorite pair of boots. Whatever happened to those? Anyway, that reminds me. I need your accountant's contact information. I have some sales tax questions.
Jerry? I usually only talk to him at tax filing time. What's the big deal with talking about sales tax now?
What's the big deal? What's the big deal? Oh, I don't know. Maybe the fact that how, why, where, and when we calculate and pay sales tax liabilities can get super complicated, especially with you throwing around ideas about mobile detailing and customers crossing state lines to seek out engine dock block.
Okay. I always assumed sales tax was one of the straightforward things about business.
I'm going to pretend you didn't say that.
Yeah, my bad. Here's Jerry's info.
Thank you. And don't worry. I'll make sure your books are set up to handle sales tax transactions as soon as Jerry confirms we're collecting the correct amount in the correct situations. Okay, so as you saw, calculating sales tax is basically multiplying the sale amount by a specific percentage, if that item is taxable. The business collects that money and then passes it through to the proper tax agency. But don't be fooled, things can get complicated quickly. For the sake of my blood pressure, I'll let one of my colleagues fill you in on the details.
Sales tax is not just what is the retail price of a item multiplied by the rate, and that's it. For one thing, it is different all over the country. But also to complicate things a little bit further, there was a tax ruling by the Supreme Court that actually changed sales tax as we know it the last few years. And it was a very famous ruling. They call it the Wayfair ruling. And basically what happened is that there is now something called nexus. There was nexus before, but it was usually physical presence nexus, meaning if the business had a physical presence in a state, then they would be subject to collecting sales tax based on certain criteria, individual to each state. But now with this Wayfair ruling, we had something called economic presence nexus. So it could be that a business has never stepped foot into a particular state, but because of the amount of economic activity, quantity or dollar amount that they have, they may now be needing to collect sales tax in that state. So it really does make things a lot more complicated because of that. Then, of course, every state has its own rules. So in some states, it could be by county that you have a surtax up to a certain dollar amount, or it could be just a percentage that goes for forever, or it could be based on whether or not they are services or whether they are tangible goods. Or it could be whether or not the services go with the tangible goods, like shipping. Is shipping taxable? In some states, yes. In some states, well, no, if it is charged with the goods that you're shipping. So there are some very nuanced rules that need to be explored for a client to make sure that that sales and use tax is being handled properly. One of the things that we often find is that it can be a bit overwhelming, and there are many rules that can come into play. We've experienced rules with general contractors versus subcontractors having different rules. The good thing is many states are trying to make it where you can call in and ask questions and they will give you guidance. And many departments of revenue in various states are very, very good and very helpful. However, some states also have a different way of collecting sales tax than other states. Some states, you remit all of the sales tax for the state and any counties or other jurisdictions in that state to one central place, explaining how it should be broken out, and they will send it off to those various areas. Then you have some states that have decided that they're not going to do that. You just send in the state sales tax, but then you have to contact each of those other jurisdictions, often by county, and remit to those. So again, it can be very different state by state. Now, at first, it doesn't seem like that alone is complicated, because once you learn the state that you're in, you're good, until you find out that your client is selling in other states, and then it can get more complicated. So there is a lot that can go on with that. So how do we figure it out? Again, first of all, contacting the state or the Department of Revenue in your area would be good, or in another state. We've contacted many and they're very, very helpful. However, you often want to have those things in writing. So many times sending in an email or a question and getting responses is very helpful. And they often have their rules online, but again, it can be complicated. What we often recommend is ultimately that our clients are responsible for knowing that, of course, with guidance from their bookkeepers and accountants. They would be doing some of that research and understanding that information. Ultimately, it is the client's responsibility, of course, but we want to give them guidance. So many times we have engaged with accounting firms that might specialize in sales tax. There are also companies that will do nexus investigations and nexus determinations for clients. There are also software applications that can integrate with the e-commerce platform or accounting platform that can also provide that type of assistance as well. The guidance that we often will share with bookkeepers as they're getting started as it relates to sales tax: if a client was a retail store in one location, then that's pretty simple typically, because they have one sales tax rate to deal with. And so if they had to manually update one sales tax rate, probably not that big of a deal and is not going to be a gross amount change typically in one location. But if we have clients that are working in multiple states, or in a state that has a lot of complicated sales tax rules and remittances that need to be done, we always want to be working with a software application that is going to manage that process for us, because it is going to just make a big difference in the ability to serve that client. Otherwise, it can be quite onerous on somebody to be keeping up with that. So again, sales tax, to say that it's complicated, that alone might be an understatement, depending on the client that you're working with. Again, the state that they're in, the type of goods and services that they sell, the types of customers they have, all of those things can play a part in it. Not to mention just the rules themselves and how the services are done and not done, and as far as sales tax and what items are taxed, and then how to remit that, how to track it, how to report it. All of those things can come into play. So there's definitely some research to be done for the jurisdictions that they need, as well as possibly a consultation with somebody that can assist and is an expert in those areas and possibly the industry that your client is in.
Now, I know we're not going to spend all this time talking about collecting and remitting sales tax, and not address the accounting elephant in the room. How do you book the transactions involved? The good news is that it's nothing too fancy and pretty similar to journal entries you've created before. Remember that $50 pair of gorgeous red pumps we were talking about a bit ago? Oh, they would pair perfectly with my leopard print handbag. But I digress. To book that transaction, we would debit cash the full $55, credit sales revenue $50, credit sales tax payable $5. Then, when it's time to pass along the $5 to the sales tax agency, we debit the sales tax payable account and credit cash. Think you've got that? Give it a go. See? Complex. How's your blood pressure doing? We all agree that making sure you're calculating sales tax liability accurately can get complicated, which is why I've added Jerry, the CPA, to my speed dial. But along with guidance from an accountant, we have another tool to help keep track of sales tax liability. Any guesses? Yes, accounting software. In QuickBooks Online, there is a Sales Tax Center. There, you can complete common tasks related to setting up sales tax rates and tracking payments. I almost forgot one of my favorite things to do in the accounting software: run a sales tax liability report. Take a look at this beauty. Each amount due to each agency all in one place. And similarly, you can view all the payments made to each agency. If that doesn't set your bookkeeper heart aflutter, I don't know what will. All right, you can go ahead and check off Learn About Sales Tax Liability from your to-do list. I'm glad you're enjoying current liability so much. Something tells me there might be another one in your near future.
Oh man.
You okay over there, big guy?
Old back injury from my racing days. Can't lift like I used to.
I know just the place for a great salt soak, but it really sounds like you need some help around here.
True, I have been thinking about hiring somebody. Pay him a little cash under the table to help out.
Cash under the table? I knew I should have had decaf this morning. Okay, Mr. Under the Table, if you want to throw your books off, possibly lose your business, and have me walk out that door, you can take the back road. But if you want to coast on the highway and do the right thing, we need to talk.
Okie dokie.
So I have a question for you. What is one of the most expensive liabilities a business takes on and is essential for any bookkeeper to understand? Any guesses? If your boss mind thought payroll, then give yourself $15 on me and put it on my tab because you are absolutely right. Looks like we're going to have to help Xavier learn about payroll to keep him on the up and up. Now, I hear what you're thinking. Hang on, Bianca. Aren't employees considered an asset? I mean, people are essential and valuable to a business, right? Yes, they are, but not when it comes to bookkeeping. Employees are important and can be expensive. I mean, no one works for free. That's called volunteering. Payroll falls under liabilities because the business owes money to someone else, whether it be the employee, another entity, or the government. That makes it a liability. There's a lot involved when it comes to understanding how and where the money flows regarding payroll. The business may owe money to the employee, one or more tax agencies, a financial firm, other entity. Knowing the payroll lingo, the ins and outs of how payroll works, and basic payroll calculations will be important for you to know as a bookkeeper and for helping Xavier. Whew, that's a lot of new terms to remember, isn't it? Don't worry, though. You'll get the hang of it, and every bookkeeper has to go through this. It's kind of like a rite of passage to becoming a bookkeeper boss, like surviving the tribal council on one of those survival shows, only there's no immunity from payroll. Let's hear from another bookkeeping boss regarding the importance of payroll and why it matters.
Payroll is extremely important and must be accurate. Of course, the ultimate role of what payroll does is to give money to employees, basically a thank you for the hard work that they have done. So, of course, it should be accurate because that just relays competence and gratitude to employees first and foremost. But also, it needs to be accurate because of all of the compliance around payroll that the government requires, whether it's state, local, federal governments. Those all need to be accurate so that reports can be given to them, taxes can be paid, and so on and so forth. So all of that is extremely important. We also want to make sure that an employee is getting the right information on their reports as well, because of course that's going to affect them very personally. More often than not, that is going to be one of the biggest factors as they are filing their own taxes at the end of the year. Their W-2, which is the report they get at the end of the year, showing what they have been paid and also what has happened as far as payroll taxes are concerned. All that's really important. So when that information is messed up, you really can potentially affect the home life of an employee. And that is not something that I think any employer wants to do. So all of those things are important. What should be happening on a very regular basis is that those pieces of information that are being put into a system that is going to be calculating the payroll, that information should be reviewed. There are so many areas of payroll that can be quite complex, from the income tax rate calculation. There can be unemployment insurance, and that often changes per year, could potentially change throughout the year, pay frequencies, and so on. You also have state withholding and federal withholding and Social Security, Medicare, and understanding all of those pieces, the acronyms that come up related to payroll. You'll hear FICA and FUTA and SUTA and SUI and state withholding and SWT and FWT. All of those acronyms are really important to understand, as well as understanding what part of payroll is the responsibility of the employee and what is the responsibility of the employer. And often you'll see ER as employer, and that's kind of the acronym or the initials that we give it. And then the employee is EE, just to have some shorthand as we talk about all of these things. But it's really important. One of the things that has been highlighted over the past several years is the importance of all that payroll reporting and the need to make sure that we understand the types of employees we have. And I know we'll be talking about that a little bit later. But it's really important to understand those pieces of it because it is often one of the areas that can be the most confusing for a small business owner. And the bookkeeper can really provide a lot of clarity and comfort to that business owner as they handle that in a way that is competent and confident. And so really understanding all of those parts and pieces is important. And I always give the little hint, take a paycheck, whether it's yours or somebody else's that you're able to legitimately look at, maybe it's your spouse or another person, and look at that paycheck and really understand the pieces of that and how those things are being calculated. It's really important. Not that you need to be doing that manually, but just understanding that overall process so that you're comfortable with it and you're able to be talking about it. That is really what the role needs to be. And again, those compliance pieces are so important because there's a lot of different government entities looking in on that payroll. So making sure that you're confident in understanding all those pieces of it and are able to work with the system that's going to be doing that accurately is extremely important.
All righty, you've learned quite a bit so far about payroll. In fact, if you had $1 for every new thing you've learned so far, we'd have to walk through the payroll cycle to figure out exactly how many of those dollars you get to keep. Lucky for you, no matter what company you work with or for, there are some universal steps when it comes to processing payroll and making sure it's done on time and correctly. Processing payroll isn't just about getting your employees paid on time. It's about operating your business legally according to the FLSA and state laws. Following a payroll process ensures nothing is missed and helps keep your payroll in compliance. Let's walk through these steps together now. Before Xavier and his sister Maria hire anyone, they are going to have to decide on a payroll system. Thankfully, there are really only 3 types to choose from: manual payroll, outsourced payroll, and payroll software. Let's talk about manual payroll first. Just like the manual shifter on that sweet 63 Stingray Xavier's got in the shop, this means you're doing all the work yourself to make a payroll run. More than that, it really refers to doing payroll by hand or on a spreadsheet. This approach is uncommon because there are just too many numbers, updates, and regulations to be aware of to be certain your calculations are correct. And talk about time-consuming? Even for a small business, time is money, and choosing not to do payroll by hand is a place where both can be saved. A second and very popular payroll system is outsourcing payroll. This means the business pays someone else to do all of it, from the taxes to the timesheets to the bookkeeping. So really, this could be an area where you, as a boss, can choose as your specialty. Companies pay good money to ensure this service is done right and on time. I told you, payroll was a big deal. Lastly, there's payroll software. I don't think I have to tell you that this is a popular choice, especially for small businesses. Payroll software varies by plan and the product a business chooses. For a bookkeeper and payroll, though, there's no better friend. With all the compliance concerns, state and federal taxes, updates, benefits, and healthcare components to consider, it's no wonder software helps businesses stay on top of timely payroll procedures. Before Xavier and Maria choose a system, they do need to consider where their business is now and where they want it to be in the future. Ideally, you want a system that can grow with your business, keeps track of updates and changes to state and federal taxes, is budget-friendly, and is easy to use. The next step is extremely important and will make other sections of running payroll a breeze or a headache if not done correctly. I'm talking about paperwork. And even more exciting than paperwork are the tax forms, baby. All employees and non-employees will have some sort of tax form associated with their information. There are certain forms you will need to complete and keep up to date for payroll accuracy. Let's hear more from a colleague of mine about this important subject.
As we start thinking about the different types of employees, you're often going to hear exempt versus non-exempt. And to start just there, what we're talking about, or what is often talked about, is whether or not somebody is exempt from overtime pay or not. And there are often changing rules, so I won't even bother quoting what those are today, because by the time you're watching anything, it could change. But you're looking for what are the minimums that need to be in place and the type of role that somebody is in, about whether or not they can be exempt from being paid overtime or not. And that's really what we're talking about with exempt versus non-exempt. Often business owners will say, oh, I'm putting so-and-so on salary and it's going to be X dollars a month, so they don't get overtime. And that may be what the business owner intends, but that may not be the law. And so there are some things that need to be tracked in every organization. If somebody is going to be non-exempt, that means that they could potentially be getting overtime pay, which means that we really should be keeping up with how many hours they work. Does not necessarily mean that they actually have to truly punch in and punch out on a time clock, but they do need to have something that states the hours that they worked if there's ever a question. So those are some considerations to keep in mind. Again, we're not the ones that write the law. We are the ones that are supposed to be helping our small business owners understand that there are rules that they should follow. These are the recommendations that we make, and ultimately they are responsible if somebody came back and wanted that information or did an audit, that they would have it, but we just need to make sure that we do that. The other area that can be extremely confusing is whether or not somebody is an employee or an independent contractor. I often hear, well, I'm a W-2 employee, or I have W-2 employees versus 1099 employees. No, you don't. You have either employees that get W-2s, or you have contractors or independent contractors that are getting 1099s at the end of the year. And there is definitely a difference. And again, there are many laws that are going to identify the type of person that is going to be an employee versus somebody that can be an independent contractor. I always tell my small business owners that we are going to lean toward employee many, many times, because there are so many rules that are making that independent contractor relationship much more stringent, that would potentially move them over to be an employee. So it is extremely important to understand that if it is an independent contractor, they are not an employee. It's not a non-employee. There's no such thing as really a non-employee. It's really, are they an independent contractor? And if they are, then they are a separate business. Even if they're a sole proprietor business, it's just me doing business for somebody. Technically, that is a separate entity and is not getting a W-2 at the end of the year. That person would be filling out a form that would identify their tax information and whether or not the type of entity they are, but whether or not they're going to be getting a 1099 or not. But they would need to be filling out that form. In reality, that form should be filled out at the very beginning of that relationship, and not trying to get it toward the end of the year when it's really hard to track some people down. Really should be done at the beginning of the year, so that that 1099 can be provided automatically at the end of the year. Independent contractors are not employees, should not be treated as such, and they really are a separate business, if you will. Now, we also have one other area that we look at when we talk about different types of employees. Again, we have the exempt and non-exempt. We have the non-employees, which are independent contractors, and then regular employees. But then what do we do about the business partner, the owner of the business itself? Independent contractors, as I said, are going to be somebody that is not an employee, and they are their own separate business. They can be a sole proprietor, meaning it can be just their name, John Doe, and that is a separate business that you are paying to do work, and they would be an independent contractor. But the owner of the business itself could be a sole proprietor or another type of entity. And that can change whether or not that owner is going to be able to receive payroll or not and be an employee of the organization. Again, states can be different. The federal laws and rules can be different based on that information. But some entities, such as a single member LLC, a limited liability corporation, or a sole proprietor, typically, if it's a sole member LLC, meaning it's just the owner, they have incorporated under an LLC, then they typically are not going to be employees. They will receive information about their business, or it could just be reported as part of their personal income taxes. And they may not receive any type of form at the end of the year per se. If they have decided to move into an S corporation status, they have had what they call an S corp election, then they may be able to be an employee. Some LLCs that have multiple members, in other words, multiple owners, might also be able to receive payroll, but there are lots of different rules and regulations on that. And so this is obviously not the place where we can go through all of those. But just to suffice it to say that as we consider the different types of employees, we also have to consider the owner themselves, the type of business that they are, and the implications that that could have for that owner, if they are an employee or not, if they are allowed to be an employee or not, and so on. Often in those scenarios, when we're starting to look at the types of employees and some of those rules and regulations, partnering with the CPA or another accounting professional to get some guidance in that, especially for newer bookkeepers, definitely the way to go, and a recommendation that I personally would make. But understanding the type of entity and the ownership structure of that business is important to determine if that business owner is considered an employee or not. And again, remember, a lot of times business owners may not really understand all of that. So having somebody provide that guidance that the bookkeeper is then able to execute on is extremely important as well. So understanding that there's some differences, understanding that there are some specific rules, that is the idea here. And then depending on the client that you're serving, you would want to dig into that a little bit deeper.
Okay, we've covered a lot of ground so far. A few steps left, and you'll be ready to kick it into payroll overdrive. We've already mentioned direct deposit is a popular choice for businesses to use to pay their employees. It offers a lot of benefits as opposed to cutting checks or preloaded debit cards. It's convenient. There's no shuffling of checks or mailing envelopes, which saves time and money. It's secure because the funds are directly transferred to the employee's bank account. There's no risk of losing a paper check, debit card, or misplacing a pay stub. Even though it's not a free service, it's an expense most businesses find worth it to ensure money flows out of your business to payroll at a specific and predictable time. If you hand out or mail checks, you have no control over when employees cash them, making it a little more challenging if cash flow is tight. Now that we've got the foundations laid, it's time to implement a way to accurately account for your employees' time. This is true for non-exempt employees or hourly employees. By law, you have to record and keep records of their time. Businesses use everything from manual time cards that employees fill out each day, to computer software that logs their time, to fingerprint scanners that physically clock them in and out. Check your labor laws to see how long you're required to keep employee timesheets and have a secure storage space for them in case of an issue or dispute. Nobody wants their hours miscalculated. I love to tell you that because this time tracking system directly affects someone's pay, that it works flawlessly all the time. But then you'd know I was lying. That's why our next step is crucial to this payroll processing cycle. Before we move further into the particulars of the payroll process, we need to revisit a couple of old friends. You remember the matching principle and the accrual-based accounting method, right? These two principles come into play with payroll when looking at when pay is earned and when pay is paid out. Remember when I said an employee is an expense and a liability? Well, we have to account for that expense as the wages are earned and then record it when it is incurred, rather than when they are actually paid out for those services. Let me give you an example of how the rubber meets the road. An employee works for a day and it has to be recorded, even if the employee's payday isn't until Friday later in the week. Let's look at a few more examples to see if you've got this. Once our timekeeping system is in place, your employees are using it, then it's time to collect all that data to begin calculating their pay. This step is critical, and not just because you have to have the information to pay folks properly, but because inevitably there will be corrections that have to be made because someone forgot to clock out or the machine was having a glitch. Whatever the reason, timesheets have to be checked for accuracy. If they're not right, the payroll will be wrong, and that's not only bad for business, but bad for the books. Using software for checking timesheets is another way to save time and ensure accuracy for calculations. You can check and calculate time cards manually, but obviously this takes longer and is more prone to error. When checking timesheets, it's important to look for specific events that will impact payroll, such as overtime, vacation, or sick leave. Did a full-time employee only work part-time hours that period? And how does that affect their benefits? All of these things need to be inspected, checked, and captured in order to properly process payroll. In fact, why don't we take a peek at some timesheets now? Now that we know our timesheets for each hourly employee are correct, it's time to approve them, input them into our system to calculate net pay, and submit it so we can show them the money. The first step is to make sure all time for all employees and non-employees is transferred correctly. Once we have time transferred into the software, it's time to ensure all of our deductions are taken out. Remember, some deductions are universal, like FICA. Others are personal, such as health insurance. And independent contractors don't have any deductions because they're non-employees. Now, as a bookkeeper, we've got to keep track of how much we've paid out to those contractors too. But we're not responsible for remitting those taxes to the government. Nice to have something off your plate, isn't it? Once we've finalized the time, gross pay, and taken all the correct deductions, You are left with the employee's net pay and are ready to submit payroll for payout. This is why direct deposits are so popular. The timing for payout can be the next day or even the same day, making both your books and the employees happy. Speaking of timing, I think it's time for another little exercise to see how you're doing with all this payroll processing. Woohoo! You've made it to the final step in payroll processing. Take a breather and go spend that $15 you gave yourself for me on something nice. The final part is essential for compliance, business health, and ensuring you have everything you need to act quickly in case of a payroll error, labor law complaint, or tax audit. I'm talking about reports and records. As a future bookkeeper, we already know you're going to be organized and methodical. So this part of payroll might just become your favorite part. You need to establish a system that keeps your payroll records organized, secure, and available. Let's jump into reports first. Reporting is as important to business as butter is to a baker. And just like baking, if your measurements are off, the whole cake can be a mess. Which brings us to being actively mindful about employee records. It's vital, essential, crucial, necessary to make sure all of your records are up to date, accurate, and secure. It's a core part of bookkeeping. In other words, don't make an icky cake. That reminds me, I really need to eat. You are being entrusted with the information that can impact business outcomes. Make sure the information you enter and monitor are up to date and accurate. Last but not least, people are depending on you to keep employees' personal information secure. Make sure you know your organization's policies on securing and disposing digital and paper information. If there are no policies, work with the organization to develop them. Stolen Social Security numbers are even more devastating than losing your Nona's super secret tiramisu recipe. So be thoughtful, be prepared, and be safe. Boy, oh boy, are you feeling like you just accomplished something? You should. Payroll can be daunting, but it doesn't have to be your bookkeeping nemesis. In no time, you will think to yourself, I'm a payroll pro. We've laid a strong foundation on the language of payroll, special considerations for processing payroll, and of course, walk through the steps to ensure payroll is processed on time and accurately. That's really something. You know what we haven't done yet, though? Capture it all in the books. How about we save that adventure for next time? Right now, I'm feeling the need for speed. Let's see if Xavier will take us for a spin in that sweet ride of his, shall we? Well. How's my favorite block doc this morning?
I'm super pumped, B. My cousin Eddie is on his way. He's going to be our first full-time employee. I've always wanted to hire someone just like Winston did for me. Eddie's a great guy, just had some hard luck, you know. He'll be here soon, so I want to make sure the shop looks good.
That's great, Xavier. You got your payroll software system all set up, and you and Eddie have agreed on a wage, hours, and benefits, so you'll know how much to take out for OASDI, right?
Well, we've got the software, and I told him I'd like him to work full-time, but I don't think we've settled on the rest, or that I know what OASDI is.
I see. Well, you might want to make sure you do before he starts. But what do I know? I'm just your bookkeeper here to rescue you from yourself. Xavier, you're almost too sweet for your own good.
All right, B. Cool your engines. I was gonna get to that. I just, he's family, so I was coming about a little less formal,
Well, in my experience, you need to do things by the book, especially with family. But that's another story. You gotta keep your business stuff strictly business. And I didn't mention OASDI to you? Well, you'll need to know that and a few other terms before we can get Eddie squared away. So clearly, we've got a little more ground to cover when it comes to payroll. And looks like I forgot to mention a few terms too. Well, I told you there was a lot involved in payroll, didn't I? Even a seasoned pro like myself can get a little flustered and forget a thing or two. But remember, it's not the size of the engine, but how sticky the tires are that counts. Or maybe I got that wrong too. The point is, we've got to finish this payroll thing strong and cross that line like a boss. Aside from all these crazy terms, what's really important is understanding how cash flows through this part of your business. A lot of those terms means you can't touch this when it comes to the money. You don't want to accidentally spend what you should have been holding for taxes, like when I accidentally spent that money I owed my sister on that fabulous scarf. Oh. Well, my sister was upset. She was at least forgiving. However, unlike my sister, Uncle Sam doesn't just forgive taxes, no matter how slick the scarf. So, understanding the where and how to properly give what's owed to whom will make you a payroll expert in no time. Payroll cash basically flows to three places. Money goes through the business directly to employees as wages earned. Money goes into a taxes payable account you'll be paying on behalf of your employees to the state or federal government. And lastly, money goes into an account on behalf of your business to pay for state or federal business taxes you owe. All of that money in those holding accounts gets remitted or sent in to the appropriate government entity at the appropriate time, using quarterly for state and annually for federal. Now that we know where the money flows, let's talk about where the money goes. On the books, that is. We know where it goes once it hits my wallet. Like everything, we've got to show a record of payroll on the general ledger. This is really easy to do, especially with only a handful of employees. But if you've grown your business to hundreds of employees, that journal's going to be as unmanageable as a batch of balloons in a top-down convertible on the freeway. Am I right? That's why individual employee information is kept on a payroll register. It includes all those specific terms you saw on that pay stub we looked at a while back. Those entries are then totaled and transferred to the general ledger. Now, the nice thing about software managing your payroll is that it does all of those register entries for you. You can then run a report to get those totals. But right now, you'll need to add a journal entry for payroll. I'm going to let one of my colleagues show you how it's done while I check on Xavier. Eddie should be here by now, and we'll have some work to do.
The entries that are created for payroll include typically potentially 3 entries. The first one, think of as an employee-focused entry. That would include debits for expenses like salaries and wages, overtime, and other things that are being paid to the employee that are an expense for the company. And of course, any deductions from an employee's paycheck. That would include things like liabilities for tax withholdings and health insurance and other benefits that are withheld from the employee's paycheck, as well as potentially any other types of withholdings, a loan repayment or a garnishment or whatever the case might be. Then you might think of the second entry being something that's a little bit more employer focused. So as you'll recall, there are taxes that an employer pays on behalf of the employees. That would be part of the Social Security and Medicare that is paid. That is an expense to the company. That's the matching portion. You might also have federal and state unemployment, and there could be other types of taxes and other expenses. Perhaps the company is matching part of the health insurance or other benefits that are being paid out, perhaps even a retirement savings, things like that. So those would be expenses, debiting the expense account, and again, crediting either cash going out or a liability to be paid later. The third entry would be the actual payment of those liabilities. Of course, it now debits that liability, so that clears out the liability, pays out what is owed, and of course would credit cash. Now, depending on the accounting system or the payroll system that is being used, that could all happen as one big entry as well. but those different pieces, the employee focused portion of it, that is the expense to the company, and then whatever is withheld and payable out, as well as the employer's expenses and whatever is payable out. And then finally, the actual payment of that, depending on the timing and how that all occurs in the payroll system, that can be one big entry, but all of those pieces are going to happen. One last thing that I'll make mention of with these journal entries, it's important to note, depending on the client, if it is going to be recorded as of the payday or if it's going to be the pay period end date. Again, something else that might need to be considered as we are talking about those entries.
Well, Xavier's cousin Eddie is here finishing up his paperwork. But before we put his information in the system, how about we let a pro take you for a test drive? A QBO test drive, that is. Xavier still won't let me drive that sweet Stingray of his. It's like he doesn't trust me or something. Can you imagine?
So a new employee is coming on. What do we need to have? Well, of course, there are some very important forms that need to be filled out, like the W-4 form. That is going to identify the employee's name and address and social security number, tax ID number, all of the key information about that employee. And it identifies whether or not, or excuse me, how they are going to be filing with the federal government as far as married or single, filing jointly, separate, whatever. All of that information is filled out on that form. Many payroll systems now, once that form is filled out online by the employee, it just automatically completes that area inside the application. That's the ideal world. But that information is required, as well as the I-9. The I-9 is an employee eligibility form that typically is going to have a couple documents that are going to identify that employee, that they are supposed to be able to be employed. And many times it includes things like a driver's license or passport. Those are the most common. And typically copies of that is going to be retained either electronically or in paper copy form by the employer. As the bookkeeper, that is something that we advise our clients on. We're not always on site to make sure that stuff happens, but we let them know. And often, depending on the payroll system used, it can be kept online in that employee electronic file that you would have per employee. Of course, there are also state forms that need to be completed. If there is state withholding taxes, then that state will provide a form that the employee also should be filling out. And there can be other types of forms. If they're going to be doing direct deposit, there are times when a voided check needs to be submitted so that that information can be entered in, or again, depending on the payroll system, they would be entering that in directly into the system by the employee, and they would be able to maintain that. So the ultimate information that we have about every single employee, there are statutory requirements for those employees on those forms, the information that we need to have. So again, understanding what information needs to be filled out and keeping copies of those and retaining those securely. Again, those employees are filling out very personal information. It needs to be held in strict confidence and security. And so that is important as well. One tip that I often tell bookkeepers as they are working with an employer to fill out these forms, as a client working with them, one of the things that's really important is that we are not providing the tax advice to the employees as they fill out those forms. Some of those forms can be complicated. Some people have a really difficult time filling them out. And while you can provide some instruction, be careful that you're not providing tax advice on what you think that they ought to file as. That is not our role to be providing that type of advice, but we are providing information to the employer and sometimes to the employees on instructions on what they do with the form, how they store the form, the types of forms they need to have, but we're not actually completing it or telling them how to complete it, providing tax advice. But all of those pieces of compliance are extremely important and definitely something that we need to know about. Finally, there are types of deductions that are important for us to understand and make sure that those are being recorded per employee. Most of them are pretty standard as far as the amounts and things like that. We do have to understand whether or not those things are being taken out pre-tax calculation or post-tax calculation. So in other words, are they calculating that deduction if an employee made $1,000 and they have a $200 deduction, are their taxes going to be calculated on the $800 or back at the $1,000? So understanding pre and post tax deductions is important to understand. It's also important to understand about garnishments. There are times that courts or states have mandated that certain amounts be taken from an employee's paycheck, and understanding if those are going to be in a specific order. Does the federal or the state have to be taken out before a court mandated one, before other benefits are deducted? Understanding that order may also be an important thing to research as well, depending on the type of garnishment. So understanding that those types of things can occur, going into that, asking the right questions and making sure that that is set up correctly, all things that we need to know as we're onboarding or assisting our clients as they onboard new employees.
So you can see why it's a little more complicated than just pay yourself what you want as a business owner. Xavier and Maria will have to follow the rules for payroll as a partnership with various roles and equity invested. Xavier and Maria are going to have to decide each partner's role in the business, and that will help determine how each receives money from the business. This will need to be clearly stated in their operating agreement. It's important to remember, neither are considered employees under this business entity. To hear a little more about why this matters and how this impacts where the money flows when paying a business owner, let's hear from another expert.
Business owners often get paid from their business in potentially several different ways, even in the same organization. So depending on the type of business, there can be a lot of different ways to get paid. And it is important to understand some of it. May not have to know every single detail, but it's important to understand that it can be different. As an example, typically a sole member LLC. So that is somebody that has incorporated their business. It is listed as an LLC, a limited liability corporation. They typically, if they are the only owner, are not getting a paycheck. They would simply take draws out of the business. In taking a draw out of the business, they are just simply taking cash out of that business when they would like. It's not technically payroll. There are no payroll taxes being withheld. There are no payroll taxes being paid by the business. And so it is just money coming out and it is going to the owner. In that entry, that is technically not going on an income statement or a profit and loss statement. It is going to be money coming out of cash, and it will be recorded against owner's equity. Sometimes there's an account called owner's draws or owner's contributions, or sometimes it's owner's draws / contributions. They put it in one account to net it out against one another. And so that's where that would go in the equity section of the balance sheet. There are some businesses, however, that are incorporated that take what they call an S Corp election. It is a different type of entity that would now be allowed to have their employer on, or the owner, on as an employee. In fact, if they are an S corporation, they should be having a paycheck for the owner or owners. Now, in doing that, they are able to have a regular paycheck using the entries that you do with everybody else. Although we do track owner's pay a little bit separately, sometimes either in its own account on the profit and loss statement as an expense, or just at the end of the year, we typically are running a report of all payroll to owners and making sure that we give that to the accountant when requested. However, as an S corporation owner, they are getting a regular paycheck or a periodic paycheck. It could be once a year, once a quarter. They also can take draws out of the business, just like that sole member LLC I just mentioned. In doing that entry, like the other draws, are not going to show up on the profit and loss or income statement. It is going to be reducing cash and going as a debit against the owner's draw contribution account. In addition, they may also have payroll. So just keep in mind that they could have potentially both types of entries. And so it's important to understand that depending on the type of ownership that they have and the type of pay that they are taking or the type of money they are taking out of the business, it can show up potentially on the balance sheet and or the profit and loss statement. There are other types of payments that can be made to owners, such as guaranteed payments and so on. That is something that is not as common. Those are there. Those details probably outside the scope of what we would talk about in here, but typically remember, if they are going to be getting a true paycheck, then that would show up on the profit and loss statement. But if instead, or in addition to, they are taking draws out of the business that are not technically payroll, then those would be showing up exclusively on the balance sheet.
So now you know how to use the payroll process to put in a new employee, pay the boss, and document all those entries in your journal and software systems. What's left to do? Well, we've got some reports to run, and we have to make sure those taxes we're holding on to for the government get submitted each quarter as well as annually. Basically, your reports will fall into two separate categories: internal reports and external reports. Internal reports stay within the business. It's important with all reports that you keep private information private and secure. These reports are primarily used to inform business financials and almost like a checkup of the health of the business overall. External reports are shared with others outside the business. This could be an investor, the government, or other entity looking to lend money or invest in the business. To learn more about the importance of reporting and payroll, as well as to introduce you to some of the more common reports you'll run, let's listen to a colleague of mine.
Payroll reports are so important as we are reviewing all the information, typically on a monthly, quarterly, and annual basis for our clients. There are quite a few reports that are important to every employer. Things like a payroll history, employer wage reports, check registers or payment registers. Even if they're doing direct deposit, often the payroll systems are calling them check registers. And that is literally an outline of every single payment to an employee, gross wages, deductions, payroll taxes, and then the net amount. They still call it a check register, even if it's for direct deposit quite often. All of those types of reports are important. Some of the reports that are probably the most important are actually technically not really reports, but more like the tax forms themselves, the quarterly tax reports, monthly reports as well that are related to tax forms. So depending on the employer, they may be filing monthly reports with the state or federal government. They definitely have quarterly reports. And of course, they also have annual reports that they are filing. All of those, while technically not a report that we think of traditionally with just lists of information, it is the actual form that is filed with those governments. Those are extremely important and are often used when doing any other type of additional reporting to an accountant or for workers' comp audits or other types of information that we need about payroll. It's just so common that we need those, that's just commonly the reports that we look at, even though they're technically not a traditional report. Keep in mind also that quite often as we're talking about payroll, we have to deal with other types of compliance issues for our clients, like workman's comp. That is, of course, an insurance that is often mandated by state, that they carry insurance in case of an injury on the job. And with workers' comp, of course, there are different rates based on different types of workers. So an office worker versus a doctor versus a construction worker will each have a different rate and a different charge that they have. And so reports for workman's comp is also extremely important. They too will request things like a 941, which are those quarterly federal reports, and others as verification of the numbers. But most payroll systems will also provide a report that will list out wages by job code used for workman's comp reporting. So understanding that and looking at those and being familiar with those are important as well. It is very common that there will be analysis on payroll. Payroll is one of the most expensive pieces of the P&L or the biggest piece of the P&L for a lot of companies. And so analyzing that data is really important to the client. Of course, there's a lot of compliance and tax issues related to payroll. So there's going to be probably a bit more scrutiny on payroll than other areas. So getting familiar with reports, wanting to understand the types of reports that that client needs to see, and just being comfortable with them. Which reports will you run most frequently? Which ones do you need to have access to? And making sure that you're saving reports in a secure way, especially with payroll. It is so sensitive and has so much information in it that should not be shared. Be very mindful of that as we're running reports, as we're looking at this data, that we are ensuring that it is staying secure when we download them. When we send them, we always make sure that we're doing that securely as well. So those are some things to keep in mind with payroll, but then also just being very comfortable and familiar with the reports, because there is no doubt whatsoever that you will be asked more often than any other part of bookkeeping that we do. You'll be looking for those payroll reports. So becoming familiar with them is going to be really important for you.
My, oh my, can you believe we did it? I mean, that was a lot to cover, and the truth is, you'll always be learning more about payroll. At least we've learned the foundational terms, concepts, processing procedures, journal entries, how to pay the boss, and necessary reports to make sure your records are accurate and up to date. I want to encourage you, because this is a serious step towards completing your training. You should feel proud about all you've come through so far. And just to show you I'm not too proud to remember what it's like to be in your shoes, I've asked a friend to share a bit more about their experience learning payroll as a newbie. I hope it will make you feel you're not only on the right track, but a part of the tribe, the bookkeeping tribe, and we give credit where credit is due. Get it? Hey there, Xavier. How's everything going? Why do you look so upset?
Huh? Oh, it's nothing. Don't worry about it. I was just thinking.
Oh, that's why I could hear gears grinding. Honey, I'm here to help you and your business. Come on, you can tell me. How bad could it really be?
Well, I needed to purchase parts for the shop, and they weren't cheap. Anyway, the vendor let me buy them on credit, and I figured I would be fine making the payments. Then business dried up, and I missed some payments. Now I just got this 90-day overdue notice, and I have no idea what to do. I don't have the cash to pay this off.
Oh, Xavier, that is a problem. Have you tried talking to the vendor?
I'm not sure what good that's going to do. I'm already so overdue. They aren't going to do me any favors.
It doesn't hurt to ask. They want to get paid too, so they might be willing to set up a promissory note with you.
A promise? What?
It's like a payment plan. Basically, they get their money back with a little interest, but you get more time to pay them back.
Oh, that would be great, but what's this going to do to my books?
Well, it's going to mean you have some new liabilities. Don't worry, I'll walk you through everything. Xavier's finding out a business can't function without money. But most business owners don't have cash just laying around to pay for things like equipment, inventory, or building space out of pocket. Because of this, most businesses will take on some form of long-term debt during their financial lives, which means they will need to account for long-term obligations on their books. As a bookkeeper, while you won't be involved in obtaining a long-term obligation, any debt that your client takes on is going to impact the financial records you work with. So, let's hop on the long-term liability bus and take a tour. Long-term liabilities are pretty straightforward. They're any debt or obligation that a business owes, which will be paid over a year or more. Ha, that's longer than I keep a pair of shoes around for. Obviously, from a financial standpoint, a business should be careful that they aren't taking on too much debt. But on the other hand, long-term debt isn't a bad thing. For example, businesses can use long-term liabilities to get cash injections into the business, purchase expensive equipment, and much more. We will talk more about some different types of business loans in a later lesson. Right now, let's just focus on working with long-term liabilities. Before we get too deep into it, though, let's hear from one of our experts to learn more about long-term liabilities.
Sometimes a client will go and buy something big and they don't have the cash for it. So what are they going to do? They're going to get a long-term loan to pay this off. It could be called a long-term liability. It could be called a long-term obligation. But basically what the client might be doing or the business might be doing is borrowing money from a financial institution or a lender and purchasing something with that loan, and then they have to pay it off. So it's our job as the bookkeeper to get that loan set up on the books. As soon as I see something in the bank activity, maybe coming out of their checking account that says loan payment, that sometimes is the first time I hear about it, because they decide to get a loan and then they're making payments, and you're going to obviously talk to your client and say, did you go get a loan for something? Can I have some information, please? Usually what I ask for is the actual loan document. What did you sign with the bank? And usually those loans are the long-term obligations are amortized loans that have an amortization schedule. So there'll be the document that they sign and how much they promise to pay, how much in interest, but then there's another sheet that will have every single loan payment listed, 1 to, well, I don't know, 70 or however many payments there are. And it will show the interest portion of each payment and the principal portion of each payment. And that document is so important because with every payment, the interest and the principal could be different unless it's a fixed kind of loan, but mostly they're not. Interest is really large on each payment as the loan starts out, but as the payments happen, the interest portion gets smaller and smaller and smaller until the loan ends. So you really need that amortization schedule because every month the payment will be the same coming out of the bank, but you're going to have to go in to that payment transaction and actually do a split, meaning this much was interest, this much was principal. The interest portion goes to interest expense. The principal portion will be coded to the actual long-term liability or long-term obligation account that you set up when the loan was first taken. So hopefully you'll see a clue somewhere in their accounting if they're not the kind of client that's just going to come to you with that document. Really important to ask them for the loan documents, amortization schedules, whatever you can get, and then get it set up as a long-term liability on the books and start booking that interest principal split payment. And that's how you handle a long-term obligation.
So your client just took on a long-term liability. Yay for them, right? But as their bookkeeper, what's your role in all of this? Well, to record it in the books and keep track of the payments, of course. Let's say your client signs a promissory note with XYZ Bank and takes on an installment loan for $30,000. The first step in the bookkeeping process is to record the initial transaction. In this case, since the client is receiving the money, your cash account would be debited. At the same time, though, we now have a long-term liability that needs to be accounted for. In this case, notes payable. For this, we'll credit a liability account. Okay, next. Wait, you didn't think we were done yet, did you? As your client makes payments, your job as a bookkeeper is to record those payments in the journal. This will look pretty similar to payments on current liabilities. First, let's say your client made their first payment of $958.33, which includes both the $125 interest payment and the $833.33 payment to principal. Keeping in mind that debits come first in the journal entry, we would start with the notes payable account, which is going down by $833.33, which does not include interest. We track that interest by debiting that payment separately. From your client's end, they pay the full amount in one payment. So since our cash account is going down, we would credit it the full amount. And there you go. From here, as more payments are made, you just create journal entries like this until the note has been paid in full. Now, before we move on, I just want to mention one slight variation when it comes to making journal entries for long-term liabilities. I mean, what type of mentor would I be if I just glossed over it? Am I right? Okay, so sometimes a long-term liability is set up at the same time that a client makes a major purchase. For example, let's say your client purchased a vehicle worth $25,000. In order to make the purchase, they made a $5,000 down payment and took out a loan for $20,000. In this case, in order to create the initial journal entry, we would set things up like this. Notice that we now have a vehicle asset account worth $25,000, while our cash is being credited for $5,000 and a notes payable account is being credited for $20,000. Now, the good thing is, from here, any payment that your client makes is going to be entered in the same way as before. It's really just that initial journal entry that is different. See, entering long-term liabilities is pretty easy, right? Well, I'm about to blow your mind. With accounting software, it gets even easier. Take QuickBooks, for example. As a bookkeeper, you will record long-term debt and payments the same way that you would for short-term debt. Here, let's jump over to a friend of mine and watch as they show you how to use QuickBooks to work with long-term debt.
So when setting up a long-term obligation, you're going to make sure it's on the chart of accounts in the long-term liabilities section, and it will end up on the balance sheet as a loan. Then it's time to make payments. So if you're using a system where journal entries are being done to record that transaction coming out of the bank account, your journal entry would be something like this. You're going to credit checking for the full value of the loan payment, and then you're going to have two debits in the debit column. One of the debit is going to be the principal portion of that particular payment, and that would be guided to that long-term liability, the loan you just set up on the books, on the chart of accounts. So the other portion in the debit column is going to be the interest portion of that overall loan payment. So that would be an expense on the chart of accounts. So you go to interest expense or something like that, and it would show up on the profit and loss statement. So again, credit the bank for the full amount of the loan payment, and then you're going to have two in the debit column. Part of it's going to principal, part of it's going to interest. You might be asking, how much is principal, how much is interest? I don't know. You need to get the amortization schedule from the bank showing each particular loan payment and what the interest principal split is going to be, and then just follow that as a guide.
So, as you've seen, when it comes to recording long-term liabilities and payments made, there really isn't a ton that deviates from the norm. However, where things really change is the balance sheet. Some companies, for financial planning purposes, like to figure out what the total amount that will be owed on the note each year. You can use an amortization schedule to help you figure that out. I'll talk more about this in the next lesson. With that amount in hand, you can split that on the balance sheet, putting the amount owed in the next 12 months as a line item in current liabilities, and the remaining balance as a line item in long-term liabilities. What this does is help businesses plan ahead and know exactly how much they need to pay each year towards the liability. Here, let's take a listen to an expert with a bit more advice about working with long-term liabilities and the balance sheet.
In general, you would think a long-term liability would be recorded when you first get the loan in the long-term liability section of the balance sheet. That completely makes sense, right? Well, there are some companies who like to report in a different way. So let's take a 7-year loan, and the loan is $7,000. That means $1,000 a year is going to be paid off. If you think about it, on day one of that loan, the total loan is $7,000. $6,000 is long-term liability. $1,000 is actually a short-term liability because that portion of the loan will be paid off within the first year. So some companies like to have their long-term liabilities reported in this way. Our job as a bookkeeper would be to journal the current year's value of that loan from long-term liabilities to current liabilities. And I've seen people do recurring journal entries, one a year, that moves that value from long-term to current. And so basically, if you think about it, the balance sheet on year 7 shouldn't have any long-term liabilities, and that last $1,000 will be in the short-term or current liabilities section. So just keep an eye out for a client that wants to report long-term liabilities in both the short-term and the long-term liability. It's just the current portion for the current year gets moved to current. And hopefully that will help you get that booked.
Hey, Bianca.
Whoa there, sailor. Looks like you got a little pep back in your step. How'd everything go with the vendor?
Your suggestion about asking them for a note payable worked. I got everything squared away and even got some more of the parts that I needed. I really appreciate your help with that.
Not a problem. That's why I'm here. So, where are you going in such a hurry?
Oh, I need to go dig out my tax returns. I'm sure I got them somewhere in the tornado that is my desk. Is that what it's called?
Oh, boy. I'm having flashbacks to a lawn care company I know. Okay, let's see what this is all about. Uh-oh. And what, pray tell, are you doing?
I need to find my tax return. I think I'll need my EIN. I actually forgot what an EIN is.
That would be an employer identification number. And why would you need that again?
Maybe I'll just give them the whole tax return. Who knows? They'll probably ask for it anyway.
Should I go get your sister?
Hey, Bianca. Thanks for your help with the promissory note. I feel like a weight's been lifted.
Oh, okay. You're welcome, I guess.
After we got that squared away, I went back to work on the detailing business. I think I'm ready to get a loan or something.
Ah, I see. Well, you have options. How about you pull over and we talk through some ideas?
Perfect. I'm gonna get a coffee. You want a coffee?
Glad to see Xavier in good spirits again. That business with the promissory note must have been really weighing on him. You will see that too when you're helping clients. The stress business owners carry over money can feel like the weight of the world. When Xavier comes back from scrounging up whatever paperwork he thinks he'll need, we'll have to educate him on the most basic options available to him when it comes to bank loans. While we're finishing up our coffee, we should also have time to get you up to speed on bank loans too. It doesn't look like he'll be back anytime soon, so why don't we start with mortgages first? Mortgages are most commonly thought of as the loans used to buy a house. But I can tell you that mortgages are also used in the business world to secure property, offices, you name it. A mortgage is a loan with the security of a lien on the borrower's real estate. A lien is a document filed by the lender to record its claim on the property in the case that the borrower is unable to pay the loan back. The borrower is liable for the unpaid principal balance plus any accrued interest expense. Mortgage loans commonly require monthly payments on the principal and interest stretching over a number of years. From a bookkeeping perspective, there are a number of things to keep in mind. A mortgage is on a piece of property or building, and so that asset should be sitting pretty, right there on the books for all to see. We already talked about how assets are recorded on the books, but in addition to the asset, there should also be a corresponding mortgage on the books as well. Another important point is the aspect of time. A mortgage is a long-term loan that will require several years to pay off. One of the biggest takeaways, though, is that any bank loan involves an outside party, which is the lender themselves, who now have a vested stake in the business. There's going to be more scrutiny over the books, and so business owners, like Xavier, need to make sure that their books are in good order. These might sound like trivial things, but their importance can't be overstated. Let's listen to an expert as they share more about mortgages.
As we talk about mortgage loans, we probably are thinking immediately of our own homes, and perhaps we have a mortgage on our home and we have borrowed money to buy a house. Well, businesses can do the same thing. They can borrow money to buy a building or property, and that is a mortgage. A mortgage is secured, meaning that there has been some legal document that has put information on that property stating that if it was sold, it's going to be paid off first, usually. And so there's going to be an asset on the books. That seems pretty obvious, but it's not always happening. So we need to make sure that if we have a mortgage, that there is an asset on the books. The other thing that I often want to make sure is, just for good clerical records, that the asset is in the name of the business as well, and the mortgage is as well. So all of that resides on the books. And of course, just like at home, you have interest and principal and possibly an escrow. All of those types of things could come into play as well with a commercial mortgage. And so you're going to see that there, again, there's an asset. The loan itself would be listed as a liability. Of course, with a liability, we consider that whether it is a current liability or a long-term liability. Typically, a mortgage is going to be paid back over several years. And since current liabilities are for 1 year, long-term liabilities are for more than 1 year, a mortgage would be considered a long-term liability. Depending on the business, they may decide that some of that mortgage loan repayment that's going to happen over the next year could be moved over to be a current liability. And so those are some changes that could happen sometimes in discussion with an accountant that may want to do those types of things. So just know that that is very common and could happen depending on the types of reporting and financial statements that need to be made. With each payment that happens, there is going to be principal payment and interest payment. Depending on the business, they may need every single payment to be split up that way. Other small businesses will just true it up or reconcile that at the end of the year to record the interest, because that is the expense piece of that payment versus the payments toward principal, which reduces the liability as they repay that loan. And so again, just like at home, those are the same types of things that could happen with a business. And so recording all of that accordingly is important to make sure that all of that is handled properly. The books are up to date, the assets and the liabilities are as they should, and of course the income and expenses are all taken care of as they should as well, to give a real reflection of how that mortgage is affecting the client's entire financial picture.
Let's take a closer look at amortization, which is simply the systematic repayment of a loan over time. Repayment of a mortgage loan is calculated with a loan amortization schedule, which is just a multi-column chart that lists out each payment required during the period of the loan itself. We do love our charts, don't we? Let's look at an example. Let's say that Xavier took out a mortgage loan for his garage. In his first journal entry, he would debit his cash account and then credit a mortgage payable account. The next journal entry would be for the first installment of the mortgage, debiting both mortgage payable and interest expense and then crediting the cash account. To determine what those amounts would be, Xavier would need an amortization schedule. Normally, he would get that from the bank. If the loan amount was $100,000 over 10 years at 5% interest, what would the schedule look like if he needed to make annual installments of $12,950? To work out the first year's payment, calculate the interest payment of $100,000 at 5% interest. That $5,000 would go in the first interest payment column, and since we know the total payment is $12,950, we can calculate the first principal payment by subtracting that $5,000 from the $12,950, which leaves us with $7,950. This would be the principal payment for year one. Subtracting this amount from the original $100K would give us the first year's loan outstanding of $92,050. We would then use this amount to calculate year two's interest payment, and so on. Using this method to calculate each year would give us a schedule like this. By the way, don't worry, I see that look in your eyes. When you get on the job, you'll have access to software that will help you calculate these things. And most of the time, lenders will send you the schedule anyway. I just want to know that you get the logic of how these things are calculated. You heard enough about mortgages yet? All right, moving on. In addition to mortgages, there are other commercial loans available to businesses. A commercial loan is basically a debt-based funding arrangement basically a kind of financing between a business and a financial institution. We saw that with mortgage loans, the property itself serves as collateral. But with a commercial loan, there is not necessarily an asset that may be associated with it. For example, a working capital loan, which would be used to finance a company's daily operations. Commercial loans can be either secured or unsecured loans, meaning that the business may or may not have to pledge some asset as collateral. One other important way that commercial loans differ from a mortgage is the time element. We saw that generally, mortgages are long-term liabilities that require years to pay off. But a commercial loan could be a short-term loan that has to be paid off within a couple of months. A commercial loan may also be a line of credit, meaning that the business is approved for a $100,000 limit, but they don't need to take the whole amount right away. For example, if the business wasn't able to pay its employees on time with its current cash flow situation, it would have the freedom to borrow what it needed and then pay it down as, say, customer invoices came in. Just like mortgages, though, commercial loans involve an outside party, that is the lending institution itself, and so there will also be more eyes on the business's books. The bank has a vested interest now in the success of the business, and they need to get paid back, you feel me? Let's hear from our expert one more time to learn more about commercial loans.
Another type of loan, or several loans that could be used by businesses, are working capital loans and other types of commercial loans. So commercial loans in a business may or may not have an asset that it's secured against, like we were talking about previously with a mortgage. So a mortgage is when they were purchasing a property or a building, something to that effect, and it secures the asset with that loan. That is a secured loan. So if anything happens, then there's an asset that goes with it. With commercial loans, they may or may not have that for things like a working capital loan. Sometimes they can have a line of credit. So the business could be approved, for example, up to $100,000 based on their ability to pay things back, and they have good credit as a business organization. Then they may or may not even have an asset that's holding that loan as a security. So there are different types of loans that a business can have. They also are going to be a loan on the books, again, potentially a long-term loan or a long-term liability versus a shorter-term liability. So it depends on the type of loan that they're getting and how long they plan to have it on the books, things like that. As before, there are interest and principal payments that can happen. Some commercial loans could be just interest repayments for a while, or potentially they would have a balloon payment. So there's lots of different ways that loans can be structured for a business. And so understanding those is important as well. The other thing to keep in mind is that there are times when the business owner themselves personally could be part of securing that asset. So it could be that the business itself doesn't have enough assets to secure it, but the owner personally does. And so they often can have a personal guarantee for that loan. That type of thing can come into play. Now, one of the things to keep in mind is that this is typically going to happen with a commercial lending institution, although some commercial loans can be done privately as well. But either way, there is now another party that is going to be potentially looking at the financials of a business. So it is important that we are thinking through this and taking care of all the transactions and all of the record keeping of a business really well. As with a mortgage, again, breaking out that interest and principal may be done on a payment by payment basis. And other times it could be that that is reconciled as interest or principal on a periodic basis, quarterly or annually. So again, it really depends on the business, how often they need to see that broken out, the way that the client is able to read their financials and understand what it's telling them, the way that they handle their cash flow, all of those different types of things. But really understanding the type of loan it is, if it is secured by an asset, making sure that asset is on the books, making sure that we understand if it is a long-term liability or if it's going to be more of a current liability, or if there is part of the loan that is considered short-term versus long-term liabilities. All of those types of things come into play. Getting familiar with that, understanding that is really important as well. Also, keep in mind that the titling of those accounts is important and helpful for the client to be able to understand what they're looking at as they look at their balance sheet. And so, really having an idea of what information is going to be provided to that business owner and potentially third parties as they are looking at those financial statements is really going to be very helpful so that you're able to provide that information in a way that's really understandable by all parties.
One idea we could toss out at Xavier is a short-term loan. These are basically loans that must be repaid within 1 year, and so are considered a current liability. To record such a loan, the business would increase both its cash and a current liability account. Since this is an option that Xavier might want to consider, let's use him as an example. Let's say Xavier goes down to his bank and secures a short-term loan of $7,000 to be paid back within the next 6 months. To record the transaction in his books, Xavier would record a debit of $7,000 to cash and a credit of $7,000 to his current liability account, notes payable, or to loans payable. So, how did it go? I need to hear all the details.
We did it! I was able to get a small business loan from my bank.
Really? Oh, that's so great!
Thanks to you, we get the funding to get things rolling. We'll be signing customers up in no time.
I knew you could do it. I'm so happy for you. What's up, Doc? That will never get old. Sorry, I couldn't help myself.
It's okay. I forgive you. This time. I'm just setting up the books for the latest orders from my detailing business. I had 3 clients sign up today. Seems my slogan, if your car is not becoming to you, you should be coming to us, really sold them.
Well, it's better than we clean your car better than you do anyway. How's the bookkeeping coming for the detailing?
I think I have the hang of it. But my sister wants to know how her stake in the business is doing. She might need to take some money out for some unforeseen work she needs to do on her Airstream trailer. It's a beaut, that trailer. Remember, she helped me with the startup costs. In fact, we set up a partnership, and we always said we would figure out how to pay her and keep track of that when the time came. I guess later has arrived.
It seems it has. So what exactly are we looking at when we talk about Xavier's sister's stake in the business? Well, before we get to that, we need to back up a little. First, let's revisit equity. The term equity represents the owner's rights to the assets of the business. Owner's equity used for a sole proprietorship. In Xavier's case, he has a partnership with his sister, so the business has partner equity. For a corporation, the contributors are called stakeholders. Did that last question throw you? Yeah, it was kind of meant to. I gotta keep you on your toes. Okay, let me clear things up. Business assets are items of value owned by the company. Equity is more like a liability to the business. It represents the owner's claims to what would be left over if the business sold all of its assets and paid off its debts. What's included in equity, you ask? Check it out. Let's look at how to calculate equity. You remember the accounting equation, right? Well, if we rearrange this formula, we can see that equity is made up of assets minus liabilities. Assets minus liabilities is also referred to as net assets. These are essentially the owner's rights to the assets of the business. It's what's left over for the owner after you've subtracted all of the liabilities from the assets. And that's exactly how you calculate it. Let's look at an example. If you look at the balance sheet for Snappy's restaurant supply, you can see that the total owner's equity is $44,000. That includes the $20,000 Snappy initially invested in the business, the $50,000 he took out of the company, and the $74,000 of profits from this year's operations. It's also the total assets of $51,500 minus total liabilities of $7,500. Either way you calculate it, Snappy's stake in the business is $44,000. Let's look closer at this money Snappy took out of the company. Now, why would he do such a thing? Well, a sole proprietor withdraws money sometimes or often from business profits. Because a sole proprietor doesn't receive a paycheck from their business, withdrawing business funds is how he pays himself for the work he performs. This also applies to a partnership. So, Xavier will need to withdraw money on behalf of his sister for her Airstream upkeep. This is called a partner's draw. Now, this is called different things in other types of businesses. Looking at our handy chart again, you can see that for a partnership, it is a partner drawing, and for a corporation, they are called dividends. Now let's look at how to record these draws, since Xavier's sister needs to make one. Well, I say need, but let's be clear on the difference between need and want. Like I want abs, but I need tacos. Okay, so any money drawn during the year must be recorded in an owner's draw account under the owner's equity account. At the end of the year or period, you subtract the owner's draw account balance from the owner's equity account total. To record draws, you need to go to the owner's equity account on the balance sheet. Record the draw by debiting the draw account and crediting your cash account. Let's say Xavier withdraws $2,000 from his company for his sister. His transaction will look like this.
Some of our clients decide it's a great idea to put personal expenses through the business checking account or maybe on a business credit card. This is not what they're supposed to be doing, but guess what? It happens anyway. So the way we deal with this is setting up an owner's draw account in the equity section on the balance sheet. Basically, what's happening is when a client decides to take some money out of the bank and keep it personally or take the kids to Disneyland or whatever it is they're going to do, we don't want to show that as an expense on the business. So this owner draw account pulls the owner's equity right out of the company. So basically, they're taking business cash or value out of the company. And that would be what the equity section on the balance sheet represents. So basically, you would set up this account, an equity account called owner's draw. And let's say the client did decide to write himself a check out of the bank, $10,000. If you were going to enter that as a journal entry, let's say, you would then credit the bank account for the $10,000 and debit owner's draw. And that will represent the money that the client has taken out of his own company during the year. So it also works with credit cards and anything else. If they spend money that's personal, using a business source account, you want to make sure you push the debit side of that over to the owner draw account. And then we're tracking how much money he's pulling or she is pulling from their company.
Let's talk about the end of the fiscal year process when there has been a draw. First, the closing journal entry needs to get posted so that it starts a new period with a zero balance. Second, the owner draw amount is transferred into the owner capital account to show that the draws for the period reduce the capital. For example, at the end of the fiscal period, a balance in the draws account is $5,000. So, a credit of $5,000 is posted to owner withdrawals, thus leaving an ending balance of zero in that account. The debit of $5,000 then gets posted to owner capital. Let's hear more about the closing process from an expert who can walk us through.
When you do set up an owner draw account in the equity section on the balance sheet, you'd have to remember that every time the owner does take money from the bank or puts a personal expense through the bank or the credit card, that owner draw account is going to continue to get a debit side of that transaction. And basically the owner draw value, the balance, is going to grow and grow and grow. I've seen companies that just let that grow. And anytime you look at the balance sheet, you can see exactly how much money or value the client has taken out of his company from the beginning. Other ways of handling that is sometimes people like to just see it year by year. So if you do want to close out the owner draw account at year end, you could absolutely do that. Some people actually journal it over to retained earnings. So if we have a debit balance in owner draw for the year of $25,000 and we want it to zero out on January 1st, on January 1st, we do a journal entry moving $25,000 from owner draw, which would be the credit side of the journal entry, and then you're going to debit retained earnings with that value. That way, every year on the balance sheet at year end, you will see how much the client or the owner took each year separately without having it pool and grow and grow and grow. And that's how you can close out an owner draw account.
Well, there you have it. Maria can deck out her Airstream trailer with the owner's draw she took. Xavier can keep track of the business draws thanks to your help in showing him how. And you can get ready for some practice on all the things you just learned because boot camp is coming up next. I can't wait to get on that stage again. See you there. Welcome to another episode of Bianca's Bookkeeping Bootcamp, where we take new bookkeepers from basic to boss. Now, I was thinking to myself the other day, we have covered a lot, and I've really thrown a lot at you. If you have made it this far, and let's be honest, you have, then you should really be proud of yourselves. Go ahead, give yourselves a round of applause. Now, my boss bookkeepers, since you have been so awesome throughout our journey, I have a little surprise for you. I'm going to share the bookkeeping mantra with you. I think you're ready for it. This mantra is only known to boss bookkeepers, and it will help you focus your bookkeeping superpowers so that you're ready to crunch numbers and balance books. Are you ready? Deep breath in. Now repeat after me. Now I am the bookkeeper. I will report, not fabricate. I will state my purpose and document. I will record money in and money out. I will debit and credit. I am a bookkeeper. Uphold ethical standards, oversee financial data, coach clients to success, empower prosperity. Record the entry, add it up, balance it out. Deep breath in and deep breath out. I love that mantra. Do you feel the boss energy flowing through your veins? It's electric. All right, now that we are focused, it's time to get to business. See what I did there? Anyway, today we are going to continue our discussion regarding the accounting equation and some common entries you'll make as a bookkeeper. Like last time, we will focus on the cause and effect relationship between those entries and their impact on some of the financial statements. Are you ready to get started? Yeah, me too. As a reminder, think of the accounting equation like a scale. As a business adds transactions, accounts get bigger or smaller. However, from a bookkeeping standpoint, if everything balances, then you know you're on the right track. Now, in an earlier episode, we focused on the accounting equation and money and transactions. You know, things like sales and accounts receivable. From an accounting equation standpoint, these entries pretty much just affected your assets and equity. Today, we're going to switch gears and talk more about the accounting equation and money out transactions. Money that a business either owes or has paid. In other words, things like liabilities. Before we jump right into it, let's hear from an expert with a few words of advice.
The accounting equation that basically is summarized on the balance sheet is assets equal the total of liabilities and equity combined. So basically, when you're talking about liabilities and the accounting equation, if you take $10,000 out of the bank, which is an asset, and pay a liability off, which is a liability, the $10,000, you're basically reducing the value or the total assets by the $10,000. You are also reducing the liability section by $10,000. So it's basically no change in equity at that point. So the accounting equation gets updated every time you enter a transaction like that. So money out transactions, payments to liabilities, all of these things are going to affect the totals in that accounting equation. If you do a money out transaction that is going to hit the profit and loss statement, let's say it's for cost of goods sold, you wrote a check for something, that is actually going to go to the profit and loss statement. The net income on the profit and loss statement rolls up to the balance sheet in the equity section. So that $10,000 may be hitting the profit and loss statement, but it's actually going to roll up the equity, so it is affecting the accounting equation. So there's all kinds of really cool ways that the accounting equation can come into play when you're doing all kinds of different transactions in your accounting system.
All right, let's talk about some of your more common scenarios. Now, we are going to go through a few scenarios. So, to make things easier, I've created a sample company with some financial reports that we can reference as we go. Let's take a quick peek. This is the balance sheet for our sample company, Business XYZ. As you can see, on March 6th, they had a total assets value of $17,200 and a total liability and equity value of $17,200. So far, so good, am I right? Now, moving over to the income statement for the same date, after their revenues and expenses, their net income was $300. All right, does everything make sense? Good. Let's take a look at some common business transactions and see what happens. For our first transaction, we're going to look at accounts payable. Now, just for a quick refresh, accounts payable represents money that a business owes to others, making it a liability for a company. Okay, now that we have that out of the way, let's take a look at a transaction for our company. On March 7th, Business XYZ hired a freelancer for 6 hours at a rate of $20 per hour. Business XYZ will pay the invoice when it's due in the next 15 days. Now, because no money has exchanged hands yet, there is no effect on assets. But because they owe that money and it's considered a business expense, their liabilities have increased by $120, and the equity has decreased by $120. If we look at the balance sheet, we can see while our liabilities have increased, the owner's equity has decreased. So, assets equal liabilities plus equity. And finally, in this case, because hiring a freelancer would be considered a business expense, this transaction will affect the income statement by reducing the profits by $120 because of the added expense. All right, now every business owner I know likes to think about all the money that they're going to bring in. But the reality is that it costs money to make money, and businesses are going to have to make cash payments from time to time. Let's look at our sample company. On March 8th, Business XYZ made a payment on their notes payable long-term obligation for $1,000 and paid with cash. This would affect the accounting equation by decreasing the assets by $1,000 and also decreasing our liabilities by $1,000. It would, however, have no effect on the equity. Another way to view this is to look at the balance sheet. Here you can see the decrease from cash as well as the decrease from notes payable, leaving Business XYZ with a balanced equation of $16,200. On our last day for this scenario, For this one, we're going to look at a sales tax payable transaction. On March 8th, business XYZ sold $200 worth of their inventory at cost and collected $20 in sales tax. The effect on the balance sheet is a little different here, so pay attention. First, there is an increase in assets for $220, since that was the amount that was collected. But there's also a decrease in assets for $200 because that inventory is gone. Now you might be thinking to yourself, hey, these numbers don't add up. And my bookkeeping bosses, you're right. Because the $220 that business XYZ collected also has sales tax included, we need to increase our liabilities by $20, since that is what was put into our sales tax payable account. In other words, if you look at the balance sheet, you can see that cash has increased by $220, inventory has decreased $200, and we now have a sales tax payable account in liabilities, leaving business XYZ with $16,220 as the total for our assets and liabilities plus equity. Wow, this one was a doozy. Let's check in with an expert for some more advice.
Sales tax payable is a current liability normally on a balance sheet. So some of the common mistakes that new bookkeepers can make with making a payment on sales tax is they don't map the debit side of that payment to the sales tax liability account. I've seen it, and I'm not going to just blame bookkeepers. I've seen business owners do it too. So it's not just bookkeepers, but basically they'll write that check to the state sales tax. And instead of choosing a liability account, which should already be set up, they are going to push it down to sales tax expense on the profit and loss statement. That is absolutely incorrect. You want to pay off the liability. So as there are sales happening that have sales tax activity, the sales tax portion of that sale should be pushed to a current liability account. And that will pool there until the payment is made and you debit that same account. So basically, if it's done correctly, you'll be crediting the checking account, which is an asset, and you'll be debiting sales tax liability, which is a liability account. And that affects the accounting equation. You know, we're reducing the asset by $10,000, but we're also, or not $10,000, whatever the payment is, but we're also reducing the liability account as well. So basically, the equity is pretty much staying the same in the business, and that's how it is affecting the accounting equation.
Well done, my bookkeeping bosses. Now, before we wrap things, I just want to leave you with this last thought. Remember earlier when I said that the accounting equation was like a scale? Well, thinking of it this way will provide you with a quick health check on your client's books. For example, as you're going through the books, if you find that the scales are tipped and the accounting equation isn't balanced, well, you know right away that something is off. When that happens, it's time for you to put your boss detective hat on and investigate the journal entries to determine where the issue is. Let's hear from an expert with some really great advice about determining accounting errors.
The accounting equation is really important because everything must balance. There always must be debits and credits that total the same all the way through an accounting period. And if it doesn't total and something's not right, it is really obvious looking at the balance sheet. And the balance sheet is basically the accounting equation with all the sub entries that total the assets, that total the liabilities, that total the equity. So first thing you would see if a balance sheet was out of balance is you look at the total total assets, and then you look at the total liabilities and equity combined. Those two numbers should be identical. And if they're not, there's something wrong. So now it's time to start digging into the weeds and figuring out what's wrong. Really depends on what system you're using. If you were using spreadsheets to create journal entries that translate to trial balance, that translate to the balance sheet and the profit and loss statement. If you're doing all this manually, it could be a formula. It has broken, something like that. So I would definitely double check that trial balance and make sure the debits in the credit column match or have the same amount. And from there, I'd push forward to the balance sheet to make sure all of those totals have come across with the correct number. You really have to do some research and dig in, like I said, to the weeds and get in there and figure out which balance is not translating over. And that is how you can start figuring it out. Now, for me, I use accounting programs because accounting programs have those formulas written in, and they generally do not break. It's something that happens automatically. So, if you don't have to do it on a series of spreadsheets in a workbook, I recommend using an accounting program that actually does those translations of those balances for you. But in general, the assets should be the same as liabilities and equities combined. And if they are not, you've got an out of balance set of books, and it's time to start looking.
Well, there you have it, my bookkeeping bosses. The accounting equation in all its glory. You know, whether it is assets, liabilities, or equity. I'm a strong believer that as long as you understand how the accounting equation works, the rest of bookkeeping is just gravy. Anyway, my time is about up. Remember what we said in our bookkeeping mantra. Record the entry, add it up, balance it out. I'm Bianca, taking new bookkeepers from basic to boss. Thanks for joining me. See you next time. All right, my little bosses, welcome back to another round of Bianca's Bookkeeping Bootcamp, where we take new bookkeepers from basic to boss. I'm very proud of all the progress you've made, and that's why I wanted to share my mantra with you. Before I get all choked up again, I'd like to share a story with you. By now, you've heard me liken the accounting equation to a balanced scale many times before. I'd like to tell you how that analogy came to me. One day, when I was a young boss, much like yourselves, I was working on a bookkeeping job that was particularly difficult. I was new and looking to impress. Well, I was sitting in this big office and there was a TV in the corner. I don't know why they had a TV in the office, but whatever. Anyway, there was a courtroom drama playing in the background. I was staring at a balance sheet and thinking about what a hot mess this business was, and the judge on TV says, "The scales must balance." Suddenly, that line reminded me of my father's business and how it ended up failing because of a bad bookkeeper, and I was reminded of why I got into this business in the first place. In that moment, I started writing down what I intended to do to be the best bookkeeper that I could. And that statement has turned into the mantra I've shared with bookkeeping bosses over the years. Let's repeat it again. Are you ready? Deep breath in. I love this part of the seminar, almost as much as I love finding a bag that matches my shoes. I love telling that story at this point in the seminar too, not just because it resonates with many of you, but also because it drives home an important theme you may have noticed this go-around, that the accounting equation scales must balance. Today, we're going to continue exploring how the scales balance with a little more payroll practice. Of all the things that can affect the accounting equation, nothing can tip the scales like payroll. Payroll can represent a significant sum you owe to your employees, and this can greatly impact what you own. As a result, payroll can have a large influence on your assets and liabilities, affecting the accounting equation and ultimately the balance sheet. Payroll is a significant expenditure on the profit and loss statement and can eat away at your net profit. This can turn up on your balance sheet as lower cash, which translates to less assets to pay off your liabilities. Listen to our expert as they explain more about this important balance.
Remember that when we are talking about payroll, we have the amount that is owed to our employees. We also have amounts that is that are deducted from our employees that are really just passed right through the organization and out to the federal and state governments that have mandated that we do that as employers. There's also deductions that could be coming out that are mandated as well for garnishments or health insurance and other types of benefits that need to be passed along, as well as, of course, just recording the expenses that the employer has to pay versus what the employee is paid and so on. So how does all of that affect the accounting equation? Of course, the income and expenses of an organization are on the profit and loss statement. Of course, you guys know that. When we pay employees, that is an expense. And so, of course, that is on the profit and loss statement. That ultimately, all income and all expenses are ultimately going to close out and go to the equity section eventually at the end of the year. But as I said, there are a lot of payroll deductions that are coming out that are liabilities. They're usually current liabilities because they're going to be paid in the year. So current liabilities are paid within 1 year. So there are going to be payroll liabilities that could be sitting on the books as well. So there could be payroll that is paid out on a monthly basis, or actually it could be paid depending on the client. It could be paid every single time there's a payroll run. Then there could be some things that are monthly and also quarterly and then annually. So if there are deductions that are taken out, for example, for federal unemployment taxes, that is typically paid annually. So there is going to be money sitting in a current liability account that are going to be paid out at the end of the year. So of course, in order to pay that liability, assets minus liabilities equals owner's equity, right? That is our accounting equation. We need to make sure that we have an asset, cash, sitting in the account for our client that is going to pay out those liabilities at the end of the year. So one of the things that often happens with employers is they think, I need to be paying my employees, let's say it's going to be a $10,000 payroll expense. And when the payroll is actually run, they see that it's not just $10,000, it's also the other employer taxes that need to be withheld and so on. It may be a little bit more. Also, it's important to remember that some of that is not being paid out potentially right now. Now, there are a few things to keep in mind as we think through all of these different payroll scenarios. Most people, most businesses, hopefully, are not doing payroll manually. I say hopefully because it is shocking how many still do. Payroll software is ubiquitous. It is everywhere and it should be used. There is a reason that we want to have payroll software. They handle the compliance piece of it. But often it is also going to deduct out the payroll taxes that are paid later. And that is all being taken care of. We don't have to worry about cash flowing that later on when the employees have been paid already, but now just the taxes are due later. So often using a payroll software is going to be very helpful in that scenario because it's just handled for them. So what we often want to do is think about every payroll that is run. There are expenses and there are also liabilities. And of course, there is an effect on cash as well. So all of those pieces are going to come into play. It is going to be an equal entry. There's cash, there's liabilities and expenses, which we know rolls into that equity section. So it's all going to balance. We need to make sure that we are helping to educate our clients that everything related to payroll is not on the profit and loss statement, that there are things that could be sitting on the balance sheet related to payroll that they will need to have the cash for later. So for new bookkeepers, understanding that payroll entry is really, really important. The amount that comes out of the bank account is not all payroll tax expense. It's not all just payroll expense. Some of that is liabilities. Really understanding that equation, understanding how it works, when it needs to get paid, anticipating the cash that's required on hand to not only handle the payroll for today, but the payroll taxes for when they are due, whenever that is for tomorrow, or whatever tomorrow date is. All of those things are important, and making sure that the client understands that when payroll happens, they do need to look at the complete picture for that client, for their business, which is the P&L and their balance sheet, understanding all of that and making sure that they are prepared for what needs to happen, or They're using software that does that stuff for them so that they don't have to worry about it. They take care of it all in one fell swoop.
And with that, my little bosses, we have finished another round of Bianca's Bookkeeping Boot Camp. The accounting equation and the balance that it brings to bookkeeping can be applied to everything, even payroll. I like to finish by saying that balance doesn't just apply to bookkeeping. You'll find it applies everywhere. The more you live and practice the mantra, the more you'll find it balancing more than just your client's books. And I don't just mean balancing a purse with shoes. I'm Bianca, taking new bookkeepers to a more balanced level of boss. Check you later. Welcome back to the final round this week of Bianca's Bookkeeping Bootcamp, bosses. In this bootcamp round, you're going to show what you know about bank loans and about equity. And then we're going to apply what we know to the accounting equation. Let's get cracking. Oh yeah, here we go, jumping right in with both feet, starting with bank loans. Let's see how this accounting equation is affected when a business takes out a bank loan. I'll walk you through as I usually do. I'm good like that. But first, a little refresher on the journal entry. Let's look at Smitty Shake Stand. On December 1st, 2020, Smitty got a loan from his bank for $500 to cover an additional industrial blender. You already know that this gets recorded in the asset account cash and the liability account notes payable, right? Of course you do. You're a smart cookie. The effect of this transaction on the accounting equation would be that Smitty's assets increase and his liabilities increase by $500. There is no effect on his company equity. Owner's equity is not affected either way, up or down, when we pay off a liability, debt to external parties. This is the initial transaction. Now, most loans have interest, as you know. You remember amortization, right? Let's see if you can make me an amortized loan repayment schedule. Now, don't you fret, hon. This is a simple one, and I've given you some hints. So, let's review. You should have come up with the following schedule. In year 1, the beginning loan principal balance is $500. The interest added to the account is calculated as 500 times 6% equals 30, and the repayment deducted is $187.05. As the interest is 30, then the principal repayment is $157.05 based on the calculation here. And the ending balance of $342.95 represents the outstanding principal balance on the loan. The first year journal entry record would look like this. The principal repayment is $157.05, which is the cash payment of $187.05 less the interest expense of $30. Now, let's see if you can create the year 2 journal entry. You got it, boss. Let's look at how this loan repayment affects the accounting equation. Let's start with the first year. As you know, the accounting equation means that the total assets of the business are always equal to the total liabilities plus the equity of the business. Looking at the accounting equation for year 1 of Smitty's loan, an asset, cash, decreases as he makes a payment to the bank. On the other side of the equation, a liability, loan, decreases, representing the reduction in the loan principal, and the interest expense reduces the net income, retained earnings, and so ultimately the owner's equity in the business. Now it's your turn to fill in the information for years 2 and 3. Ready? That was too easy for you. Well, I'm going to lay a little bit of new information on you now that I didn't get to before. In an earlier episode, we looked at how equity changes through withdrawals, but we haven't yet looked at equity changes through earnings. Let's look at an example real quick before we apply equity changes to the accounting equation. Fernando is a book cover model and set up his own studio for photographers to come shoot in. His current balance sheet looks like this after he took a bank loan for $25,000. He completed his first modeling contract and is paid $5,000 in cash. His cash account increases from $30,000 to $35,000. Since he used his own studio, wardrobe, and set, he owes nothing to anyone else, so he earned the whole $5,000. Now he has to decide where to record his earnings. Since assets increased by $5,000 because he received cash, and the amount of liabilities didn't change because Fernando owes nothing extra from the $5,000 he earned, we know that equity has to increase by $5,000 so that the accounting equation is kept in balance. The increase in equity was earned by Fernando's company. It wasn't an investment, so it's recorded as a separate category of equity called earnings. Now let's review changes in equity caused by withdrawals, just to round things out. Fernando needs some cosmetic treatment and takes out $1,000 from the company bank account because he doesn't have the cash in his personal account. Remember, any money an owner draws during the year must be recorded in an owner's draw account. This withdrawal causes his cash account to go down by $1,000 to $34,000. And his equity to reduce by the same amount. Now, a company can have negative equity. Say Fernando needed some major cosmetic overhauls and withdrew more than what was in his equity account. He would essentially overdraft his equity. Hopefully, his cosmetic procedures would be worth it and would allow him to earn more to invest equity back into his company. You remember from an earlier episode how equity is made up of assets minus liabilities, right? Well, if we look at Fernando's books after his withdrawal, we can see that his assets of $72,000 minus his liabilities of $28,000 equals $44,000. That's the accounting equation applied. High five, y'all. You are not holding back with the awesomeness now. I know bookkeeping can seem intimidating at first, but with like most things in life, it's like looking for your phone. Most of the time, it's in your hand, and you've got this in your hands, my little bosses. And on that note, I'm wrapping up this Bookkeeper Bootcamp session. Keep living by the mantra. Record the entry, add it up, balance it out. That's all from me, Bianca. Peace out. Hey, Xavier, what's up? Uh-huh. Okay, I'm on my way. Looks like Xavier could use our help with a little something. Let's get going.
The Intuit Academy has created new training for those who are interested in learning all about taxes. Intuit Academy's mission is to offer cutting-edge online training programs that 1. Unlock high-demand job opportunities. 2. Ensure Intuit's customers receive a world-class service from highly skilled experts. And 3. Foster a culture of learning and growth, attracting and retaining high-caliber talent to the Intuit Expert Network. The Intuit Academy is committed to helping learners develop the skills they need to be prepared for jobs in the innovation economy. Whether they own a business or want to switch careers, the Intuit Academy Tax Level 1 training is here for those with the courage to grow. This training is a transformative learning experience designed to prepare all types of learners to take a tax exam. The courses introduce learners to foundational tax topic information using real-world scenario examples. The Intuit Academy Tax Level 1 training is a way for individuals to gain knowledge of tax principles, the tools needed to identify problems, brainstorm solutions, and much more. The training promotes creativity, critical thinking, complex problem solving, and other skills that are valued in today's workforce. This training is key in promoting skills to prepare learners for the workforce and to position themselves as credible job candidates. Those that successfully complete Tax Level 1 will be invited to explore career opportunities with Intuit's TurboTax Live. Individuals who complete the Intuit Academy Tax Level 1 training will be encouraged to add their badge to their LinkedIn profiles, resumes, and other career builder tools. Individuals will also be invited to take future courses created by the Intuit Academy.